We are now 60,000 dividend investors strong. To celebrate this amazing milestone, I'm going to be answering your questions in today's video and the next few videos. I first want to sincerely thank everyone who has subscribed to my channel. It means the world to me. My goal is 100,000 subscribers and we are well on the way. And so get ready. I have 7 subscriber questions that I will answer today, including the very popular one of why I will not invest in Microsoft. So stay tuned for that one as well. Get ready for another dividend investing video. All right, everyone. So celebrating this milestone, I just had to do the video in my backyard again. It happens to be Memorial Day. It's really hot outside, and so I thought it would be a good day to film outside. But also I was thinking I want to get back to my roots. And I know a lot of you out there with the quarantine and shelter in place restrictions have been asking, Ian, why don't you do some more videos outside? And so I thought this would be a good opportunity to do so, just to bring a little bit more nature, outdoor feel into the videos again. And so I want to start with the first question right now. I'm going to pop it on the screen for all of you to see. This first question comes from my man, Kieran. Kieran was asking, Ian, once you reach the point of retirement, how do you plan to manage your portfolio? Will you withdraw all dividends to live on or try to leave some to keep reinvesting? And he said, thank you for the amazing content. Kieran, thank you so much for the kind words. First and foremost, the kind words really mean the world to me. And so you have a really good question. And I'll tell you, this question I'm going to answer as I answer all questions to my specific situation, because my situation is going to be very different than anyone else's. But the way that I look at it at this point is I don't look at it as flipping the switch at all. Thankfully, I'm in a position in life where I have an opportunity really to throttle up or throttle down my active income and the work that corresponds to it. So if I want more active income, I can throttle up my work and work a lot harder. That's what I've been doing lately, really working hard. Or if I have the opportunity to rely more on dividends and have less active income, I can throttle the active income well down. And so the way I look at it these days is I'm not going to get to some magical point where I flip the switch and live off of dividends. But what I am doing already is paying some of my bills with dividends. And as the dividends get bigger and the dividend income starts getting a lot larger, I will continually throttle down my active income and throttle up the amount of dividend income that I'm using to pay bills. Now, it just so happens I'm in my late 30s. I still have a lot of energy. I have the ability these days to work very hard. I have 2 young kids, so I'm already up late at night, already working hard. So I figure it's a good time to continue to work actively right now to generate as much income as possible so that I can build the nest egg. I can add more money into dividend stocks. So I'm kind of in that active mentality right now. But as the stages of life progress, really what I'm looking to do is to throttle down that effort, that active effort, and throttle up the amount of passive income that I use to pay bills. And it'll just so happen that the way I will throttle up the passive income is literally, instead of reinvesting all of my dividends or most of my dividends, I will just keep reinvesting fewer and fewer dividends. And eventually the dividends, they will just be used to pay bills. But I'm this person, I'm kind of one of these persons that I enjoy working. I enjoy the active part of it. Now, I probably, the pace I'm going these days, it's not sustainable. I can't do it forever. I can do it now in my 30s. As I get older, into my 40s and 50s and 60s, will it be possible to do something like I'm doing now? Absolutely not. And so I'm taking a conscious sacrifice these days to generate as much active income as possible to get that income working for me in the stock market. But I'll tell you, let's say my situation were a little bit different. Let's say I was at 65, the traditional retirement age. if I were at 65 and I were kind of in this position, hypothetically, if I just need to flip the switch and go from making an active income to living off of dividends, I would say overall, I would prefer if my dividends were at least 120% of my expenses. By having that extra 20% buffer, it would help me deal with unexpected expenses that come up. But again, because I'm not 65 and because I'm at this stage in my life where I want to optimize my lifestyle, I'm not looking at it as flipping the switch. And because I have the opportunity to dial up or dial down active income, the way I'm looking at it now is literally just a trade-off between passive and active income, and largely taking the approach of active these days to build the passive quicker. So really good question, Kieran. Thank you for that question. And I want to pop another question on the screen for all of you right now because it is very similar and it's kind of a follow-on to Kieran's question. So check it out. And this question comes from my man, Nils. And so thank you so much, Nils, for asking this question. By the way, my subscribers, all of you, I love you all. These questions are coming from my Facebook group. And so thank you to everyone who's in my Facebook group. Really appreciate it. We have a thriving community over there as well as here on YouTube. And so just thank you everyone for those fabulous questions. So my man Nils was asking, one, what type of margin do I want in my retirement cash flow before retirement? Your investment should yield X more than what you need to ensure you can survive a downturn. And so this is the question, is a repeat of the last one. Again, if I were 65 and I were just going 100% dividend passive income now for living expenses, 120% would be the benchmark. That would be the number I would be looking for. But again, because I'm not 65 and I'm looking now to enjoy the benefits of dividend investing far before the traditional retirement age, I literally just look at using some dividends to pay bills, and the more dividends I use to pay bills, the less active income I need, so I can just kind of throttle my active income down into the future. And so good question, Nils. Now, the reason though I'm asking Nils' question here as a follow-on to Kieran's is his sub-question number 2. So check this out. So sub-question number 2, he says, what do you think is a good mix between real estate and stocks? I know you're in commercial real estate, but data from Great Britain shows that more than 20% of retired people own a second home that they rent out. And he said, should that be part of your retirement strategy? And so this is a really good question. So I have 2 answers to this. One, generally speaking, I prefer dividends versus passive income from real estate. And I'll tell you, there's a few nuances here, but one, passive income from dividend stocks is true passive income. Literally, set it, forget it. Yeah, I have to stay up to date with these companies, but quite frankly, the types of companies I invest in, like Starbucks, do I really need to stay up with it at all? A lot of people out there are not going to agree with what I'm saying here. It may be a little controversial, but quite frankly, I feel comfortable just putting money in Starbucks and not looking at another 10K annual report metrics for the next 20 years. I would feel perfectly comfortable with that. And quite frankly, I'd feel comfortable doing that with most of my stocks. Set it, forget it, let it do its thing, look at it maybe in 20 years. I have no problem with that. It's true passive income. Put the money in, don't have to do anything. Now, with real estate, it actually is not true passive income because there is a lot of upkeep, a lot of management, a lot of heartache, a lot of worry that goes into managing any kind of real estate. And in this, talking about real estate such as a home that you live in, you have to repaint the home, you have to fix things that break, you have to do projects, things need maintenance, and so there's all of that type of stuff. And I'm talking also, though, about real estate that you rent out. When you rent something out, are things breaking on your tenant? Does it need a leaky faucet fixed? Are the appliances breaking? Is the coat of paint wearing out? Is there a leak in the roof? Maybe the roof has passed its useful lifespan and it needs new roofing. And so real estate is active in that sense. And yes, you can delegate stuff to property managers, but property managers in general are not going to do as good of a job that you or I would do ourselves. And so for that simple reason alone, I prefer the vast majority of my passive income coming from dividend stocks because it's true passive income. It allows me to turn that side of things off and go to the beach, go running, go do whatever I want to do that without having to worry about anything extraneous. And so that's point number 1. Now, point number 2, let's talk about this. I've said this before, and I think it's important. Investing can be emotional, and it's okay to have investing emotional. I have an emotional tie to the stocks that I own, such as Starbucks. I love it. It's emotional, and I've talked about this on my channel. I think it's good for dividend investors to be a little emotional because it keeps us tied to the investments that we're making. Now, with real estate, I'll tell you, if we were ever to move from the residence we're in now to, let's say, a bigger home at some point in the future, I don't know if we will or not, but if we were, I have an emotional attachment to this residence because of the amount of work we've put in. I've done a lot of work with my own hands. I'll tell you, just this last weekend, I spent a lot of time doing some projects in the house. And so, because of all of that, because of the sweat equity, if you will, I wouldn't want to sell this thing. I would want to keep it and rent it out. And now, is it the best use of the money? Would it be a tremendous concentration of passive income in a single asset? Yes, it would. That's another downside of real estate, or at least single family home in expensive areas like the Bay Area type of real estate. And so that's something to keep in mind. But I'm just saying, answering Nils, your question, I would have that component for myself if we ever did move. If we ever moved, I would keep this asset. We would keep this asset. We'd consider renting it out and have that as part of our retirement strategy, as our passive income strategy, whether that be part of the early retirement strategy or longer term. Now, what I'll also say is, many of you know I work in commercial real estate. And in my role working in commercial real estate, thankfully, I have the opportunity to get a stake in some of the projects that we work on, the ones that I work on. And the thing is, what's so interesting about it all, I don't really have that much of an opportunity to throttle up or down my ownership percentage. It's largely a function of, we take a Warren Buffett-like approach. If there are no good deals, we're gonna keep looking, and I'm gonna work my heart out. But I ain't finding any deals. But if there are good deals, I'll cherry pick it. I'll find a deal or two and do them, and it takes a long time to complete the deals, develop the deals successfully. But that's just how it goes. And so largely because of that strategy, I can't just say, oh, I want, say, X percent of my money in commercial real estate. I'll do it through my job and go for it. And so it's more a function of what is coming to me. And when something good does come my way, yeah, I have a little opportunity to throttle up or down. But long story short, it's more arbitrary what my stake will end up being in those ventures. But I'll tell you, and again, not. I guess that would be more passive than active, in the sense that it's part of a bigger company and we have a team, and it's not all falling on me to manage everything like it would be if I were renting out just a residence. But a few nuanced points here. One, because I work in this field, I feel more comfortable investing in the deals because I'm investing in my deals, and I know they're good because it's my work effort. But let me tell you, just theoretically, let's say I had an opportunity just to invest in some real estate syndicators deals, who's not me, not my deals. I wouldn't do it at all. Personally, I would feel more comfortable just investing in real estate investment trusts, publicly traded entities, again, from the standpoint that less concentration of risk, more passive, easier to manage, etc. So the only reason I'm doing the real estate stuff is, one, it's my profession, but two, I have control over stuff. I have control, and so that's an important nuance point. Now, cutting to the bottom line here, because Nils was just wondering, how would you split the funds theoretically if I could? I would want at least 65% of my passive income coming from dividend stocks, and those stocks could include real estate investment trusts. I would say 65% or more. So 35% or less coming from real estate entities such as single family house, if we ever decided to do something like that, rent it out, and commercial real estate stuff that I do as part of my profession. Now, again, I don't have full control over that because, like I said, deal flow, etc., there's a lot that goes into that. But again, I would just say, if I had to pick an arbitrary number, that's what it would be. And the point of picking this number is to illustrate, again, more diversification with dividend stocks. More stability, more passive, less margin for error, so on and so forth. And so that's how I would do it. I know a lot of other people. Look, I know a lot of people where they are real estate people like me, real estate developers, and they're nearly 100% passive income, retirement income will come from real estate assets. And so everyone needs to pick the solution that works for them. I'm just speaking again, as always, to my personal situation here on my YouTube channel. All right, so that was question 2. I want to jump into question number 3 right now. Question number 3, I'm going to pop it on the screen right now. And this one comes from Blaine. Thank you so much, Blaine, for the question. And Nils, by the way, thank you as well. Thank you so much. So Blaine's question is, this is a good one. He's asking about General Mills, a stock that I own. And he's saying if you have a winner like General Mills, it's up 40, 50%, and I see limited growth in the future, would I hold forever or sell and redeploy the capital into another name that has more growth potential? So first and foremost, I want to just say General Mills has run up. That said, is the run-up over? I don't think so. I don't think it's overvalued. I don't think it's going to crater from here. I'm not adding to it, but I just want to point out that nuance. This goes to my last video. I think that there are some permanent scars in society and people, humanity, that come out of this nasty pandemic, and one of them is the need to eat at home and to have provisions at home, at the very minimum, out of fear that something like this would happen again. And I do want to illustrate that my viewpoint is California-centric. A lot of people mention Ian, but you're a little biased here because you're in California where the politics are really radical. You're absolutely right. I live in a unique environment here in the Bay Area in particular, where people take things to a very different kind of level than the rest of the country, in the United States, perhaps in the rest of the world. But nonetheless, I use my local data points. I call it real world data points. And this is one of my favorite parts of this community. We're 60,000 strong. We should all share in the comments below local data from our local markets. I love seeing that data. It helps us all become better investors. And I'm just saying, in my local market, there are permanent scars. People here are fearful. They're fearful that another pandemic will come, that we'll be locked up at home again. Who knows? Who knows what's coming around? And so people want their provisions. They want their food at home. And so, long story short, I think General Mills is a winner. But to go back to my man Blaine's question, let's just assume it is overvalued. With something that is any of my stocks, any of the stocks that I own, I'll never sell. And so no, I just won't sell it. And the reason for that is I'll say this. When it comes to selecting stocks, I totally believe that the market is not efficient. And I totally believe that I have power to do better analysis than the market, the collective market, and to pick stocks and to buy at opportune times. That being said, once I own stuff, what I've always found is when I start trading, or I start mainly selling, I try to sell this, buy that. Usually speaking, it's not the right thing. I'm not making necessarily the best decisions, and quite frankly, I don't think anyone out there is going to be making the best decisions. I believe in this bar of soap analogy, and I believe that once I own something, handling that bar of soap, it's only going to diminish returns, because you handle the bar of soap and water, less and less soap is available over time until it's all gone. You're dwindling away results. And so for me, because of that analogy, because of the fact that I do believe that handling the portfolio too much is going to minimize long-term gains. I'll have better long-term results without making those trades, if you will. I have resorted these days to basically buy and hold forever. Now, there will be exceptions. There will be times when I sell a stock in certain extreme cases, but generally speaking, even if it's run up, I will not sell it, because the market in certain cases may know more than I know. In those types of cases. And if I trust myself that I bought at the right point, that I did my analysis when I bought, I'm okay just holding it. Now, worth noting, General Mills, it is not a ride or die stock for me. It's not one of my favorite stocks of all time. And so for that particular stock, I'm not reinvesting dividends. I'm taking the dividends from General Mills, and I'm either paying bills with it or I'm putting it into one of my ride or die favorite dividend stocks of all time. And net new capital is not going into General Mills. It's going elsewhere. And so I use those levers of selective reinvestment and new capital to skew my portfolio towards the goal allocation that I want. And so I will get to my goal by selectively not reinvesting in General Mills. But again, I keep it in my portfolio because it's kind of like checks and balances, if you will. Government has checks and balances. You know, president may want to do X, Y, Z, but he needs the House and the Senate to vote it into law, for example. And so it's the same kind of checks and balances. Like, I never want to get too full of my abilities as a stock market investor. And I'm great at analyzing stocks, but I need the checks and balances. And the way I have the checks and balances is not when I'm buying, but it's when I'm selling. And because I don't sell, it's a check and balance to make sure, one, I'm doing my analysis, I'm doing the right analysis when I buy, and two, that I'm just not making any emotional decisions. And I'll tell you why. I'm not that much of an emotional buyer. I'm just always buying because I love investing in stocks. I love buying. But I found for myself, at least on the sell side, I can become a little emotional. I can get caught up into things. I can feel like, well, I need to sell this right now because of this emotional reason, markets this or that. And so by limiting my ability to sell, by putting that check and balance on myself, again, it keeps the emotion out of my personal investing. And so that's why I do it. So Blaine, thank you for the support. Thank you for subscribing. Great question. I'm going to move on now. Pop it on the screen right now. I have another question. This one comes from Carlo. And Carlo was saying, not sure if you answered this before, but do you invest in a Roth IRA, and do you recommend we max out our yearly contribution in Roth before contributing in a taxable account? So first and foremost, I don't provide any recommendations here. I'll have the disclaimer at the end, but I'm just sharing my personal journey. But I want to speak here just to my personal journey, my personal opinion on retirement accounts. Personally speaking, this goes back to the first question from Nils. And who else was it? Kieran. And so Nils and Kieran were asking about margin of error, margin of safety. They said, Ian, you're 65, you have to retire tomorrow. How much dividends do you want coming? At least 120% of living expenses. But Carlo's asking here about Roth and this and that, retirement accounts, 401k, for example. The reason I historically have been a proponent of retirement accounts and maxing them out is I look at it as a safety net. I look at it as a buffer. I even said earlier in the video today, I'm kind of in a situation where I throttle down active income, use more passive to pay for stuff. At this stage in my life, at least, I don't need a big safety net on the passive income. I could kind of just go for it because I have a belief that I could throttle back up active income if I need it. One of the reasons I have the confidence behind that belief is because of retirement accounts. By having retirement accounts, even if they don't perform as well as my dividend stock portfolio, even if I can't touch them now, it's that safety net. It's that safety net that, hey, something happens, something bad happens, who knows, unexpected. I look at it as insurance, as a form of insurance on my dividend investing. And so, yes, I am a proponent of retirement accounts, historically speaking. And it's really that very reason. I look at it as buffer. Now, that being said, hypothetically, if I were I'm older. I'm in my late 30s, and so 65, it's a ways off, but not as far off as it is for a 20-year-old or for someone in their young 20s, early 20s, late 20s, much further off. And so, hypothetically speaking, if I were kind of younger, and let's say my resources were more limited in terms of investing, I only had so much, and it was either retirement or nothing, retirement and no dividends, or dividends and no retirement. Those types of trade-offs, again, all I'm saying is each individual investor needs to make up the mind for themselves. And I could totally see a case for, hypothetically, a younger investor just foregoing some of these retirement accounts in the short run to get the dividends kick started, especially someone who wants to be my age, late 30s, and be done with it, be living off of dividends. Accomplishing something like that so young requires a certain amount of focus, certain strategies, and certain sacrifices. And so that's all I'm saying is I could totally see certain investors going that route, going just all in dividends. But again, for me, for what it's worth, risk-averse type of person, I know I have delayed my retirement from dividends further into the future by having retirement account strategy. But again, having that buffer, having the passive income full retirement a little bit later in the future, it's worth it to me. It's flat out worth it to me for the peace of mind. So that's how I look at it. Really good question, Carlo. Thank you for that, my friend. Thank you for subscribing, being a loyal subscriber here on the channel. Really appreciate it. So let's do it. Next one, I'm going to pop on the screen next. Next question. This one comes from Marty. Hey, thank you, Marty, for being on this channel for such a long time and being in the Facebook group, being active. Really appreciate it, my friend. And so this question goes like this. Wells Fargo is at huge lows. Is it still, am I still going to go ride or die? Or should I ignite Wells Fargo, go for it under 25 per share? And so for me, Wells Fargo, it's been really tempting, and I'll share why. I'm going to pop it on the screen right now. I have some statistics behind Wells Fargo. It's trading at almost 24 and change per share, 8% yield, 8% starting yield. You don't even need to grow the dividend at that kind of starting yield. Now, I'll tell you, the payout ratio is a massive 206% for 2020, but it gets down to a respectable 71% if everything rebounds, goes according to plan next year in 2021. But has a compound annual growth rate of 6.3% on that dividend. And the forward PE for 2021 is a attractive, juicy 8. And so, yes, Marty, this is really attractive to me. I've been thinking lately, should I just buy some deep discount value like Wells Fargo? Not a lot, but just a little. I'm tempted. The only reason I haven't so far is I am here. I need to get here. In terms of goal allocation, I shared this in one of my recent videos that I want to morph more towards a centralized portfolio around my ride or die positions, my favorite positions of all time. And to get from where I'm at now to my goal, it's going to require a lot of focus. And anything I do that is against that focus delays it even further. And so that's why so far I haven't been buying any Wells Fargo recently or some of these other deep discount value stocks. That being said, sometimes the value is so enticing that maybe I'll just go for it. So I can't say one way or another what I'm going to do now. And if I do buy Wells Fargo some more, it'll be a really small tranche. It'll be something small, but it'll be something just to say, hey, I saw the value and I did it. But I'll tell you, it's undeniable for me right now that I think there's value there. I like it. I want to buy more. But again, I'm torn. I'm torn because I have goals. And quite frankly, some of this comes down to testing myself and testing my willpower. And I feel like if I buy Wells Fargo, I'm kind of, in a sense, going against my willpower, because my willpower needs to get me from my current allocation to my goal allocation. If I don't have the willpower, I just kind of feel like, what am I really doing here? What am I doing? Willpower is really important to me these days. And so for that reason, I don't know. I just can't say what I'm going to do here. But yes, it's tempting. No, I haven't done it so far. And the reason, again, is the willpower and getting to goal allocations. So thank you, my man, Marty. Really, really appreciate the question. And thank you for all your contributions there to the Facebook group, all the great questions and community involvement. All right, I'm going to move on. All right, James. Let's see. I'm going to put that on the screen right now. I love this question. And so this one comes from James, and he said, how do you feel about the recent releases of fractional share access that many brokers are starting to allow? Do you see it as a game changer? Newer generations, they don't have the money or the patience to save up for a full share. He says he just got fractional shares. And so I love this question, James. Thank you for asking. I want to say that, yes, I think it's a game changer. I love fractional shares. I've been a fan of fractional shares for over 20 years now, for a long time. And so brokers are now offering fractional shares, and I love it. And they're doing that with the ability to avoid commissions as well. And so it's great for smaller investors. For me, I've always been a fan of brick by brick by brick, just staying in the game, staying tied to it, because it's not only, saving up for more shares. The challenge with that is when you're saving up for more shares, you're out of the game. You're not as involved in the market. What I've always found is there's kind of two components of getting to financial independence, passive income. One is just selecting the right stocks, having the right strategy. But two, honestly, even more important than portfolio performance, it is staying in tune with the game, staying in the game. because it's so easy to get distracted. It's so easy to go out and spend money on this, that, or the other. And so to stay in the game, I like to be buying stocks pretty much every week. And you guys know one of the things I'm doing recently is I'm buying Starbucks every Monday. Now today's Memorial Day, and so thank you, by the way, to our men and women of service and the families who have supported those men and women for the many contributions they've made, so that, quite frankly, I can be here right now on YouTube sharing knowledge, engaging. We can all be engaging as a community. So God bless all of those men and women who paid the ultimate sacrifice for the rest of us. So in fact, let's take a quick moment of silence here for all of those heroes, those fallen heroes. So yeah, Memorial Day. Anyways, I will be buying my Starbucks stock tomorrow on Tuesday, and it's an expensive one. I'll just share some stats on the screen right now, but it's an expensive stock, but I'm buying it ride or die. I'm sure it'll look cheap 30 years from now, 20 years from now. But yes, the question is so important, and I did a video about this a few years back, actually in 2018. So I want to share this. I'll share a link in the description below, but I'm going to share a screenshot right now on the screen. It's kind of funny that my man is asking this question right now. Thank you, James, because you see right here on the screen, this is me a few years ago sitting in the corner with the Post-it whiteboard. For all of you that remember that and have been around since those days, bless you all. Thank you for being here for the long haul. And so I'm not going to rehash the whole video here, but long story short, what I talked about in that video is that there is a vehicle called Dividend Reinvestment Plan, or DRIP. There's also ones called Direct Stock Purchase Plans, or DSPs. These are becoming more expensive these days, and so they're not, I would say, quite as relevant these days as they were, say, 5 or 10 years ago. But there are still low fee or no fee DRIPs. These are great programs for all investors because they allow you to dollar cost average, and they allow you to own stocks in your name instead of the street name. When you buy through a broker, it's in the street name. And so there are many good things about these programs. There are cons as well. But what I'm saying is the fractional shares, they've been around a long time. They've been around for a really long time. And so it's not necessarily a new thing, but they have become new to brokers. And so long story short, they're becoming more widely known because most people have not known about DRIPs. They're not something very widely advertised, if you will. And so yes, I'm happy with the existence of fintech and with the new disruptive creations. And again, these creations are, I would say, nothing new because the DRIPs have been around forever. But whatever you want to call it, I love them because they're bringing investing and dividends to more people, which I think is so important. Because one of my recurring themes here on the channel is dividend investing. It is for everyone. This community is for everyone. And one of my favorite things is dividends are one of the best vehicles, in my humble opinion, that give the little person, the little guy, an opportunity to have wild, huge financial success that is truly passive. And so for that, I love these fractional shares. Now, the other thing I talk about in this old video, though, is that historically, most of my trades, or many of my trades, have been smaller. Some of my trades have been as low as $50 per trade. Then some of them have been quite higher, quite a bit higher, as I discuss in that video, up to 10K. And so the point of the video, though, is I did a whole analysis of all of my trades, and many of my trades, in fact, 41% of my trades by dollar amount were less than $1,000. 10% by dollar amount, total aggregate dollar amount invested, were less than $200. And so you see in that trade, actually, it gets more interesting by count of trades. 54% of my trades have been less than $200. Now, this was through 2018 when I did the video, so there's been more data since then that would change these numbers, but you guys get the idea that I am the biggest proponent around of smaller trades. And the data in that video shows it, and I did an analysis in that video also just of my commissions, and my commissions ended up being 0.46% of total dollars invested. And so even though I've done all these trades historically, commissions did not come back to hurt me or haunt me at all. They've been just fine. And so the point of all of that, though, is fractional shares are not necessarily a new thing, but they're new to many people because of these disruptive technologies. But I'm such a fan. I'm such a fan. And again, it's mainly to stay in the game. And again, so many people focus, oh, did your portfolio beat the S&P 500? Are you beating the benchmark? Are you selecting the right stocks? And I think, don't get me wrong, I'm a huge fundamental analyst. I spend a lot of time analyzing stocks. You guys know this. Picking stocks is important. But I would say it's more important to stay committed to an investing strategy than picking stocks. And how do you stay committed? You stay committed by investing in small, bite-sized chunks. And quite frankly, investing should be for everyone. And not everyone has huge dollar amounts to invest at any time. And I'm talking about everyone in terms of how much income someone makes, but I'm also talking about everyone in terms of age group. And so fractional shares open it up. They open it up to everyone. And so, yes, I love it. Hands down. Look, I have money to deploy. I rather average it out. That's just how I do it. It mitigates risk as well. It's not only about staying in the game. It ensures that I mitigate risk, which is really important. And quite frankly, I feel like I get a better weighted average cost of the shares I'm buying by dollar cost averaging in, because I can't time the market perfectly. So great question. So I want to move on now to another question. This next one comes from Temeka. And so now this is the last question. I know this is the one that some people have been waiting for. Temeka was asking why I don't invest in Microsoft. And so first and foremost, I don't pass any judgment here. I wish everyone who is in Microsoft all the best. I wish anyone who is a board member or who owns shares of Microsoft, like Bill Gates, for example, I wish them all the best, just fine. But, and again, people, you can judge me. I own the sin stocks. And I even did a whole ebook on free, by the way. I can link to it in the description below about sin stocks. So I'm not one to judge one way or another. But for me, sometimes there's something about a company where I just can't get aligned with it. And with Microsoft, it just so happens to be, and I wish him nothing but the best. But for me, I choose my business partners wisely, if you will. And I think it's important. I use the word ride or die for a reason in my portfolio. They're literally the stocks that I will ride with. I will ride with, like Nelly. And so I look at that in life too, with how you choose. Who. Just giving some thoughts to the younger people here, thinking about getting married. Choose the ride or die. That's when you know you should get married, when you found your ride or die spouse. And so kind of your friends. You don't need to have all these friends. I see this trend. I see this trend in this area, and it's just so weird. I saw this a lot at when I went to college at Stanford. People had so many friends, but like a lot of friends. But none of them were really good friends. They're not real friends. I see this a lot, superficial. But for me, I'd rather focus and have really good friends. Shout out Joe if you're watching, my man. I hope you're watching all the way to the end. Shout out Bernie, my friend, if you're watching as well. I like to have really good friends, ride or die. And so I choose choose them all, choose them wisely. And so for me, when I'm selecting stocks, I got to get behind the management teams. And again, I don't want to preach this or that because, like I said, I own all kinds of stocks. And a lot of people would argue some of the stocks I own, energy industry, sin stocks, this or that, or they, hey, I love them all and I think they're all contributing to this world. That's why I own them. But again, let me cut to the chase. I personally don't want to select Bill Gates as my business partner. I don't feel comfortable doing that. I wish Bill Gates all the best. I hope he does very well with the shares he still owns in Microsoft. But because of his history with Microsoft, he's not in the picture anymore now, but he was for a long time. And I know he still has influence. But he stepped down recently to pursue his foundation full time. I just can't do it. I don't feel comfortable selecting him as a business partner for me. Now for you, maybe he would be a good business partner for you. And I wish you guys all the success in the world. I wish him all the success in the world and anyone he's affiliated with. But that's just how it is. That's how I feel when it comes to Microsoft. And so that's the most professional, eloquent, elegant way I can say it. There's, maybe there's more I could share, hey, we'll have another meetup at Starbucks one of these days. So make sure to check out the meetups. But that's just how I feel right now. And I don't want to just pick on Bill Gates. There are many stocks I don't invest in, and some of them are for financial reasons. Some are for just people reasons, where I don't quite align with people that are involved with the company, and I don't want them to be my business partner. I won't do it. That's just how I feel. And so, all right, everyone, thank you for making it to the end of today's video. I love you all. Please subscribe, like, comment. Best way you can thank me. We are 60,000 strong. Let's get to 100,000. Let's do it. Dividend investors strong. Before I leave today, in terms of full disclosure, I am long Wells Fargo, ticker symbol WFC, and Starbucks, ticker symbol SBUX. I own both of those in my personal dividend stock portfolio. Also, before I leave today, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. Just sharing my personal journey here on YouTube for fun and entertainment. Investing carries a ton of risk. Before you go out and invest, please consult a professional financial advisor first. Just sharing my journey here for fun and entertainment. All right, everyone. Hope you have an amazing week. Love you all. I'll see you in the next one. I'm going to do more questions. I got a lot of questions. Keep them coming. Put them in the comments below if you got questions. I'll do my best to get you answers. All right, everyone. I'll see you soon. Have a wonderful week.